Chris Hohn, a famous British hedge fund manager that manages a $42 billion investment portfolio with TCI Fund Management, has returned a market-beating annualised return of 18% since the fund's inception in 2003. In more recent times, after releasing his 13F filings for Q4, there is a particular company that Chris has been buying more and more of that I want to talk about today. And that company is Microsoft. So we're looking at this filing before taking a look at Microsoft itself, why he's buying more in more recent quarters and what he's selling to do so, before discussing whether it's a buy at its current valuation by carrying out our own valuation model. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So this is Chris Hohn's investment portfolio. It's about $42 billion. And he's one of the investors that I watch one of the closest. When he reports his 13F filings each quarter, I take a look at it because I'm a bit conscious of the fact that he may find something that I miss. He has a lot of quality names in his portfolio. He's a big believer in Warren Buffett's investment thesis about the long-term quality holdings outperforming. And he's also one to give a lot back to charity as well, which is also very nice. But if we look at his individual holdings, there are a few similarities between my portfolio and this one that I quite like. Visa, I've got a higher allocation to, around 18%, but he's got about 12%. He's also got the likes of Moody's and Microsoft, which I would prefer to have in the portfolio but don't at the moment. S&P Global, I have a small allocation to, below 5%, and he's got around 12% in that. Along with Google, he has around about 9 to 10%, and I've got around the same. So there is similarities, but there also are differences. GE Aerospace, this is not something I'm familiar with. It's not a company I've even really looked into, but he has 18% allocation to it, and it's actually done fairly well for him. And then he has the railroads, CP and CNI, which I do understand having. They're more of a defensive holding. They grow slower, but they are good, well-established moats. They're really good for that sort of thing. And they're always going to do well on downturns. So I really like those businesses overall. But the key position that I want to talk about today is Microsoft. He has over 13% allocation now. He's added around 16.71% in the last quarter. So let's have a look at his activity. He has been buying into Microsoft and massively sort of selling a little bit or trimming a little bit of CNI in the past 2 quarters. So he's funding the Microsoft purchases by selling out of CNI. In Q3 of 2024, he sold about 1% of CNI, around 4 million shares, and he bought around 1.5 million of Microsoft, around 1.43% of his overall portfolio. And then we have Q4, similar story. He added to Microsoft again, around 2%, around 2 million shares, and sold a considerable amount of CNI, but also sold a bit of Geo Aerospace as well. So if you ask me, these trades sort of tell us a bit that he's actually liking this at its current level. Now, we don't know exactly when he was buying. We do have a 3-month or 6-month period where he's been adding to Microsoft. But if we look at the past year, it's done pretty much nothing. So over the past year, where the S&P 500 is up around 23% or something close to that, Microsoft is actually around about flat, up by about 2%. So that's quite telling. It's underperformed, and Microsoft isn't generally one to underperform. So I can sort of see where maybe he's been buying around this $400 to $420 mark, I think. And you can see it's playing with that line here, really dipping below $400. Now, why has he been selling the likes of CNI then and buying into Microsoft? Well, there's a few different reasons. Articles like this would talk about the fact that Microsoft is the new investment AI play that Chris Hohn has got, and he wants to double down on that and keep adding to it because he believes it will do well in the likes of AI and stuff like that. To me, I think this is a bit of clickbait. I don't think that's necessarily true. I don't think he's investing in it solely for AI. I think it's more based around the fundamentals of the businesses and how they deviate from the likes of CNI. And it's quite obvious when we look at a few different things. So the revenue for the likes of CNI is pretty much flat or round about 6 to 3% growth over the past 3, 5 and 10 years. Over the past 10 years, it's only had a 3% CAGR in revenue. Now that's actually considerably very low, and they only have around about 17 billion in revenue now in December 2024. It's very slow growth. Obviously, you could argue this is a railroading business and that's to be expected. But when you compare it to Microsoft, you can see that there is a hell of a difference. And this is one that is quite obvious when you look at these charts. One's going up very predictably, quarter over quarter, years over years, and that is Microsoft. So here we have Microsoft revenue. It's going from the likes of around about 88 billion in 2015 all the way up to 261 billion. So it's more than 4 times in that space of time. It's grown at about a 12% CAGR over the past 3 years and 11% CAGR over the past 10 years. So I think that's really impressive and something that Chris Hohn is actually quite liking to see. He talks about the predictability of businesses and how they will continue to compound over time. And this is what I think he's seeing with the likes of Microsoft. Looking at another metric, we have their cash from operating activities. So the likes of CNI are sitting relatively flat on this metric. We're talking minus 1% over the past 3 years. So not even in relation to the CPI there, it's below that. And over the past 10 years, it's only grown at about a 4% CAGR. That's really slow. That's not good growth at all. And I know we're talking about a railroading business here, so we've got to give a bit of benefit of the doubt. But to me, I don't like seeing this at all. Whereas cash from operating activities for the likes of Microsoft is a different story. We're seeing great, strong cash from operating activities or operating cash flow. Over the past 3 years, a 14% CAGR, and over the past 10 years, a 15% CAGR. So it's sort of really sitting around a 15 to 14% CAGR in operating cash flow over the past 10 years, which is really good. And it just shows the predictability of Microsoft's business model and how it's continuing to grow into the future. So I really like seeing it. Now, I know that obviously we're comparing the two, and maybe we shouldn't be because one is a defensive holding and one is maybe arguably a bit more of a growth company. But Microsoft is a hell of a lot bigger than CNI. And CNI is just still not growing even that fast for a railroading business. So I like this trade. I think that I prefer Microsoft and I would prefer to own it at these sort of levels with the likes compared to CNI. So now we've got to ask ourselves, is Microsoft a good buy at these current levels? And when I first look at a business, I would look at their moat and established sort of predictability. There's no real problems with Microsoft there. There's no real problems with their balance sheet, and they have strong sort of fundamentals. So there is really no problem with that. So now we're looking towards valuation. And one of the first things I like to look at is generally historical free cash flow or operating cash flow. In this particular case, we're looking at generally how profitable the business is, what sort of multiples they're traded at in the past, and what they are currently trading at now. Because it gives us an insight into what price people are willing to pay for the likes of Microsoft over the past 10 years. And in this particular case, we've got a price to free cash flow sitting around 43 times and a price to operating cash flow of 24 times. Now, there's quite a bit of difference between those two metrics. The main reason for this is the likes of AI and stuff like that. Because obviously Microsoft, along with Google and Amazon, are spending loads of money on capital expenditure. That's made to build out their AI capabilities, and in this particular case, it's actually reflecting poorly on their free cash flow growth. It's actually weighing it down, whereas their operating cash flow doesn't have that because it doesn't include capital expenditure and is still looking fairly good. So if we look at this with the averages, we've got the likes of around about a 29 times price to free cash flow compared to the latest, which is down there at 44 times or 43. And then we've got their price to operating cash flow of 21 times over an average of past 10 years compared to their latest, which is 24 times. Now, I would say their operating cash flow hints more towards fair valuation, and their price to operating cash flow is more on the overvalued kind of thing. But we're not looking at these in isolation, we're just trying to look to inform our decision making. One thing I'd like to note as well with the likes of Microsoft is that this graph right here just shows that people are willing to pay more and more money in terms of metric and margin expansion. So another company that's experienced this is the likes of Apple. And we've seen a massive multiple expansion over the past, 5-10 years even. So 2016, this company was trading at a price to free cash flow of 17 to 18 times and a price to operating cash flow of 13 times. Really good, strong metrics for a buy of Microsoft at these sort of growth rates. But now we're having to trade for a much more of a premium, and we've got to ask whether it's actually worth doing. So we'll use maybe a different metric to free cash flow when applying our DCF, because I do believe it's inflated at the moment. Now, the metric I've used is operating cash flow. That's mainly because we're trying to limit the sort of impact and try and get at the intrinsic value of this business through its high capital expenditure at the moment, which won't always last. In this particular case, we're going to do a 5-year projection of operating cash flow, and I've set a growth rate that sits around 12%. Now, we saw before, over the past 5 years, they've averaged around about 18%, but I think that's come down now to about 14%. So I think this is a conservative growth rate, but one that's easily achievable for Microsoft. We've got shares outstanding, slight buying back of shares around less than 1%. Dividend growth rate above that 10%, so I've just given it the 5-year average of 10%. And then a price ratio of operating cash flow that sits below their 5-year average around 22 times. Obviously, we have to look towards the future. This business is going to be maturer. It may have slowed down in growth and may then trade at a slightly less operating cash flow multiple than it is right now. If that is all the case, then we have a buy radius that is not really sitting where we are right now. Now, if you ask me, this is sort of sitting around fair value. Their stock price at the moment is about $415. The fair value we've got is around $431. And we've got a CAGR around the market average of 10 to 11%. It doesn't really give us any margin of safety. And obviously, there could be an uptake in growth on these conservative estimates. So we could argue for the for and against. But I really don't think this is a bad price to be dollar cost averaging in or regularly putting money into Microsoft, which is sort of what Chris Hohn seems to do. Seems to be trying to shift his portfolio a little bit, percentage by percentage, into the likes of Microsoft, which I think is a higher quality holding than CNI. So at the moment, I'm not really buying into this sort of position at these sort of levels. We've seen it trade pretty much flat for the year. I don't think that's going to continue. But I would say that the fundamentals have yet to catch up enough for it to be screaming a buy to me. But that's just me and that's my outlook. But I do like that he's buying into this company and selling out a little bit of CNI. What do you guys think? Do you like this particular holding? Do you think it's a buy right now? Let me know down below. And as always, I thank you for watching and I'll see you in the next one.